In our previous lesson, we discussed expectations theory and how it affects the market's behavior. In the current lesson, we will discuss macroeconomic indicators measuring an economy's growth. The GDP rate is the most well-known growth rate in the field. The rate measures the change in the market value of all final goods and services produced within an economy in a given period of time. The rate can be expressed on a month-on-month basis, on a quarter-on-quarter basis, or on a year-on-year basis. It is the widest measure of economic activity and the main indicator of an economy's health. A higher than expected rate tends to provide support for the currency of the economy the rate refers to, while a lower than expected rate should be considered as a negative. Then we move to purchasing managers' indices. The PMI is an economic indicator that surveys purchasing managers in businesses of a given sector, say for example manufacturing. Investors use the PMI surveys as leading indicators of economic health, as these surveys are usually released ahead of official data. The indicators survey the manufacturing sector and the services sector, while a combination of the two provides us with a composite PMI figure. Also in some economies, such as the UK, the construction sector is surveyed. The importance of each sector depends on the structure of the economy. For example, for the UK, the services sector's PMI figure tends to outweigh in importance the manufacturing sector's reading, as the majority of the country's GDP is produced by the services sector. In contrast to the UK, for the Chinese economy, the manufacturing sector's indicator tends to be under watch. We should bear in mind that the indicator bears a reading from 1 to 100, with the reading of 50 being the cutoff point between expansion and contraction of economic activity for the particular sector. Overall, a larger than expected reading tends to provide support for the currency, while a lower than expected reading tends to weaken it. Then we move to industrial production. Industrial production is a measure of output of the industrial sector of the economy. The industrial sector includes manufacturing, mining, and utilities. It should be noted and not be confused with the manufacturing sector's output growth rate. Overall, a faster growth rate, especially if it exceeds market expectations, tends to strengthen a currency, and while a slower rate of growth tends to weaken it. Next one would be the durable goods orders. They reveal the new orders which are being placed with local manufacturers for delivery of long-lasting factory hard goods, which may be used in the manufacturing process. The indicator is also met under different names depending on the source and the economy, and it's considered to show the confidence placed by businesses and their willingness to actually invest in long-term assets in the economy. Also, please note that the rate is expressed as a headline rate, which we described, while also we may find a core version that usually tends to exclude transport costs from the equation in order to minimize the possible effect of oil prices. It's understandable that should the rate accelerate beyond market expectations, it tends to provide support for a currency, while a deceleration or even a decline of the rate in the negatives could weaken a currency. In our next lesson, we will discuss specific indicators about inflation.